Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Haitian International Holdings Limited annual report. Haitian International Holdings Limited is a diversified investment holding company that offers a wide range of businesses and services. At its core, the company specializes in the manufacture, distribution, and sale of plastic injection molding machines under two prominent brands, Haitian and Jaffier. These products cater to various industries such as automotive, packaging, medical, electronics, logistics, consumer goods, and white goods. In addition to manufacturing and sales, Haitian International Holdings Limited is also involved in the trading of plastic machinery and related accessories. This indicates that the company not only produces but also sources and supplies a range of products to meet the needs of its clients. Furthermore, the company offers software for plastic injection molding machines, which suggests a focus on providing comprehensive solutions to its customers. The company's services are not limited to manufacturing and trading. It also engages in the distribution and sale of its products across mainland China, Hong Kong, and internationally. This global reach allows Haitian International Holdings Limited to serve a broad customer base and expand its market presence. Overall, the company's diverse range of businesses and services positions it as a key player in the plastic injection molding industry. Haitian International Holdings Limited maintains a market capitalization of $36 billion, broadly in line with the industry peer group. Haitian International Holdings Limited trades at a lower price-to-earnings ratio of 10 times and a lower price-to-book ratio of 1.37 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.56%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. Revenue growth is primarily driven by significant changes in the global industrial chain, which has led to increased demand from certain downstream industries. The expansion into foreign markets has also contributed to revenue growth, with notable increases seen in new energy vehicles and 3C products. These sectors have experienced substantial growth, with overseas sales of new energy vehicles increasing by 26.4% and components and services for 3C products rising by 15.6%. On the other hand, revenue decline is primarily due to a high base effect in daily consumer goods. This sector has seen a decrease in revenue, likely due to fluctuations in market demand or competition. Interestingly, certain expenses have remained relatively stable despite changes in revenue. Employment costs, raw materials and consumables used, sales commission and after-sales service expenses have all increased by around 10% or more. However, the provision for reversal of impairment of trade receivables has seen a significant decrease of 49.8%. Net income experienced a notable increase, with growth rates of 7.2% and 10% observed in 2 separate periods. This upward trend suggests that the company's financial performance is improving. However, despite this growth, net profit margins actually declined from 19.1% to 18.6%. This discrepancy can be attributed to a slight decrease in profitability, which may be due to various factors such as increased costs or reduced efficiency. Meanwhile, gross profit margin remained relatively stable, increasing by only 0.2 percentage points from 32.5% to 32.7%. The company's financial performance has shown a significant improvement in its ability to generate operating cash flow. In 2025, the company reported an operating cash flow of RMB 3,479,819, which is a substantial increase from the previous year's figure of RMB 2,101,403. This upward trend indicates that the company is successfully managing its operations and generating sufficient cash to meet its financial obligations. The positive operating cash flow is a crucial indicator of a company's financial health, as it suggests that the business is able to cover its expenses and invest in growth initiatives without relying on external funding. With this improvement, the company is well positioned to continue its growth trajectory and achieve long-term success. The company's debt level and interest expenses have undergone significant changes in recent years. One notable change is the increase in bank borrowings, which rose from RMB 2,011,287 to RMB 3,004,717. This substantial increase in debt has led to a corresponding rise in interest expenses, with a jump of RMB 16.4 million in 2024 to RMB 77.7 million in 2025. The impact of this increased debt is also evident in the company's net cash position, which decreased from RMB 4,118.8 million to RMB 3,049.8 million. This decline suggests that the company has been using its available funds to service its growing debt obligations, rather than accumulating additional cash reserves. Overall, these changes indicate a significant shift in the company's financial profile, with increased borrowing and interest expenses becoming more prominent features of its balance sheet. The management is optimistic about the company's outlook, citing several key points that indicate a positive trajectory. Firstly, the company has successfully diversified its product offerings to cater to diverse customer needs in a market with shifting industry demand. This strategic move has enabled the company to tap into new revenue streams and expand its market share. Furthermore, the sales figures have shown year-on-year growth across all machine models, driven by increased foreign trade and capacity investments within the domestic automotive supply chain. These developments suggest that the company is well positioned to capitalize on emerging opportunities and continue its upward trend. Overall, management's comments convey a sense of confidence in the company's ability to adapt and thrive in an evolving market. There is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases or sales of assets or businesses during the period under review. This suggests a stable and conservative approach to business operations, with no major changes in its portfolio or structure. The company has a history of paying dividends to its shareholders. In 2024, it paid out 0.73 HKD per share, and in 2025, it increased this amount to 0.8 HKD per share. This indicates that the company is committed to returning value to its investors through dividend payments. The payment of dividends suggests that the company has generated sufficient profits to distribute a portion of them to shareholders. The fact that the dividend amount was increased in 2025 implies that the company's financial performance improved during this period. While there is no information available on share buybacks, the company's focus on paying dividends demonstrates its commitment to rewarding investors through cash distributions rather than other means. Concerns about inventory buildup are rising due to significant increases in finished goods and work-in-progress inventories. The data shows a substantial jump from a decrease of $494,218 in 2024 to an increase of $21,642 in 2025. Furthermore, the provision for write-down of inventories has also increased from $10,039 in 2024 to $51,763 in 2025. This suggests that companies are struggling with excess inventory, which can lead to wasted resources and potential supply chain disruptions. That concludes the financial summary for Haitian International Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.